Welcome to TradeTheMBI.com. This is John. This report is for the 16th of January, and you can see, we had the Martin Luther King holiday, and it was a continuation move. And what we've been seeing is this significant rise in the euro, but the story's been told here with that cyan under red on our DOC. Yes, we've experienced a little bit of weakness at times, but all that is just an indication that you're going to get a little bit of consolidation. Now, while these numbers for the red DOC and green have been pretty phenomenal, the reality is we've barely had any upticks in orange, and particularly when you see those breakouts still inside the green here, even when it was above the 13.5, not going to produce much. And in fact, all we got was a return to the ABM, which is all we were expecting because it's still very strong. And you just have more short interest starting to creep in. We'll probably see an effect on that later on in the month, but we're getting to a point where at these levels, while it seems overbought, the reality is we can trade sideways for a while and have a reset of that, which effectively you've seen right back here at the middle part of November. And this is all cause and effect. The impact of the tax reform is going to work its way through, and really the unknown effect of it obviously is the growth aspect, and so the market is pre-pricing in a bonus factor to that, coupled with what the known quantities are going to be, and they're quite substantial. So again, this is something I talked about throughout the year, about the change in the multiple and how many in the market would miss this concept. Mainly because I don't know if it's just the amount of time it's been since we've had pro-growth policies that they've forgotten their impact and what they can be. And, despite the fact that they're still running a deficit, when you look at the numbers, if the Fed had not increased rates, we would have already had a balanced budget for the year. The $200 billion deficit that was ran in the last quarter, and that really would have been zero, but for the fact that rates have gone up. So it'll be interesting to see if they continue to dampen that down. And then, of course, what impact the tax reform will have, particularly when it comes to taxes from higher income states. But the revenues are going to skyrocket to the government as well because the growth has that effect. So the NQ, likewise, not as strong as the S&P. And you can see that from the weakness here in the steel, but it's completely reset, so it's a bonus there. And you don't even have the same overbought status. So there's still more room in the NASDAQ than there is in the S&P. You can already see pre-market continuing to move. There's that euro move. And this all relates to the whole China news about not buying treasuries and the whole switch over, and then all of a sudden you saw this massive climb. Of course, everyone claims that it's more growth and inflation in Europe, and that's all baloney, because what's taking place in Europe is exactly the same thing that's happening in the US. So there's a parity there. This is just about a rotation, and I think some of it has to do with broader geopolitical things taking place. The idea that the Chinese, can move their, support, so to speak, from U.S. treasuries into euro is sort of an indication, that, Trump should be careful with his North Korea stance. Of course, you've seen some of that stuff soften a little bit, but the interesting things about the embargo with North Korea and that, and the oil tankers, and the miraculous burning of an Iranian tanker accidentally hit by a cargo ship where all the crew dies and things like that. These are little things that don't seem like much, but if you look at them in a broader context and then you see these kinds of moves, you begin to get a broader view of it because there's no rational basis for that euro move based on the growth rate in the U.S. versus what's happening in Europe. So a slight recovery in treasuries despite that, because the Fed jumps in and supports these things, which is always interesting when you have the government issuing debt and then an agency that's not government related but certainly runs economic conditions buying that debt is very strange. So it's always fun to see that kind of stuff. The real story here is the oil, and I've been talking about this for a while as it's been slowly marching up here, and most people were talking about this excess supply, but as I said, as the economy heats up and the amount of demand grows, it's going to create supply constrictions back and forth, and that's going to press oil, and so we can see that that's starting to return. Not to mention, again, this is another geopolitical thing. You no longer need to squeeze Iran, Russia, and those kinds of things to get compliance. And the U.S., even with its production, still there's a huge demand for oil around the world, and that's only increasing. So all has its impact, but see, everyone knows that pays attention and what this is going to lead to. This is the final unwinding of quantitative easing, which means a lot of this liquidity that everyone's talked about for all these years has really not existed in real terms until it actually gets put into the economy, which is actually starting to take place, and these electronic credits are being converted into actual resource money as opposed to just sitting in banks. Inflation is going to make its comeback, and with the limitation in immigration, things like that, you're going to get a tightening of the labor supply, and that is going to squeeze wages up. And so this is a precursor to that expectation in a significant way. And we talked about it all the way down here, that these were great opportunities to add to long-term position in gold. And as we've talked about before, remember how I discussed the inverse relationship between the cryptocurrencies and as it related to gold, and how when they were rising, gold was falling, and then when that inflection point happened, we talked about that short. Gosh, we'd have to shrink this chart quite a ways to get back to that initial marker. It was right back over here. With the 16, now also the signal that happened up at the 20,000, but this was the beginning of what I considered was that broader short move, and we haven't seen much in the way of creating any new highs. In fact, we've just had a continuation of it maintaining flatness, except for this little peak here to right around 14, but that did not last long. That was really very tiny moves above the 50%, and they've all retraced to it, and then we ended up with this huge short signal. And look at the massive amount of short with the cyan all the way over, plus 13. Significant distribution there, and sure enough, it led to the lows. And again, this is something we talked about here, that when you don't get the reset of the steel, not to mention the fact when it's above the 13.5, it's the effect of it being, coming from down below at times. But look at this, minus 30 from a DOC reading for the green, and that they're just no long-term, mid-term buyers at all. This is just mostly liquidation, people taking it. But now, you could dip easily down here into the 10,000 range. The shakeout is very low. You get a little point where you get a typical pop when you get to some of these exacerbated levels. Minus 24 on the red, where minus 26 usually causes a bounce back, and that's what you're seeing. But again, the relationships, we identified them early, and if you pay attention to them, you can clearly see what's taking place. So obviously in the holiday session, it's pretty much nothing happening here. We're getting pre-market for the setup. And again, there's no negative news. The world scene is relatively stable, despite Hawaii's false alarm situation. Kind of an irrelevant thing, but it was a big hype. But it certainly isn't going to affect what's taking place from a business cycle standpoint in that. And it's looking pretty strong. So from that daily, we saw there was a little bit of a cyan fade. We might see this pull back into it. You can see it's a little bit overbought. So we'll get a little retrace back into the ABMs, and we'll see if it continues or creates a DOC spread. But we're pretty much flatlined across here. And that usually leads to just a decent amount of consolidation going across there. So all in all, good stuff, and staying with it. But you know what? We can plop this one up here. This is from the NBI Opus again. Entered into a Starhawk there that was going into close, had completed those other trades back before. What is our performance report on this? I haven't looked at that one in a while. Let's see what it calculates to real quick. So, already making a huge move to begin the year. If we look at performance graph, we're up and around equity highs on this version. And this is the lower yield one that doesn't do as much. If I plop up the chart of the other one, which has the double contract, should be getting close. Well, we're at equity high. So we already had the previous one equity highs. This one's actually completed that, moved it higher. The returns from this one were a little more robust because it does the double contract. And so far for the year, 100%. Well, it's currently in the current trade, so we'll see how that one fares. But been pretty consistent over the years. So no objections to that whatsoever. But it's always good to point it out every once in a while. As always, though, anything relevant I will put on the Skype chat. Trade well.